On today's World Insight, oil prices in the doldrums by the all-time worst U.S. crude benchmark amid a raging pandemic, and the new development bank in support of developing countries combating the coronavirus. We speak to the bank's vice president to find out more.
Keeping people in employment is the #1 priority.
Here is our host, Tian Wei.
Hello and welcome to World Insight, live from Beijing. I'm Tian Wei. Oil may be one of the world's key commodities, but the coronavirus pandemic has brought the fuel industry to its knees. On Monday, oil prices plunged into negative territory. This might mean producers ended up paying buyers more than $37 a barrel to get oil off their hands. Oil prices had an uptick on Tuesday, but not that much. So what does it mean to the overall economy, and what does it mean for the future of the oil industry? Before we loop in our panelists, take a look at this backgrounder.
Empty streets, few trips, stagnant oil. With lockdowns came a steep slump in the demand for oil, with fuel still pumping out and nowhere left to store it. Too much supply spelled disaster. On Monday, oil prices headed for catastrophe. For the first time in history, U.S. oil dived into negative territory, a death knell for the entire industry. That means oil producers are paying buyers to take the commodity off their hands. The price of a barrel of West Texas Intermediate, the benchmark for U.S. oil, fell as low as minus 37.63 a barrel. Meanwhile, Brent crude, the international benchmark, was down 8.9% at less than $26 a barrel, the lowest in 18 years. Downplaying the historic drop as a short-term problem, U.S. President Donald Trump sought to buy millions of barrels of oil to top up the nation's strategic reserve.
We're filling up our national petroleum reserves, the strategic reserves, and we're looking to put as much as 75 million barrels into the reserves themselves. That would top it out. That would be first time in a long time it's been topped out. We'd get it for the right price.
A little over a week ago, OPEC members and other big oil producers such as Russia agreed to slash global output by about 10%. The deal was the largest ever cut in oil production, but it won't take effect until May 1st. The oil storage capacity of the U.S., both on land and sea, is filling up. Since March, stockpiles in some locations have risen by 50%. Oil is traded on future contracts, and fears of not finding a place to store oil sent prices tumbling. Traders are now paying to get rid of oil instead of buying it. Black gold may keep the wheels of industry turning, but a constant supply is too much too soon in a time of slowdowns and lockdowns.
More about that. I'm first joined by William Li, the chief economist of the Milken Institute, before we have also our access to our Chinese expert. Mr. Li, good to see you.
Good to see you.
Thank you for waking up early to talk to us from the Los Angeles Times. Thank you, sir. Mr. Li, tell me more about exactly what this would mean for the future price of the oil. As we know, this is about the May contract price.
Yeah, I hate to go into a very technical discussion, but I'm going to have to because of the nature of the futures market for the oil industry. This is the negative price is not the price of oil. It's the price of the contract that people engage in buying a barrel of oil that's due for delivery at a certain time. In this case, we're talking about the nearest contract is June. And the problem is that most people who buy these contracts don't really have anything to do with oil. They don't want the oil. They're only trying to speculate on the price of oil itself, And right now, the technical issue is that anyone who owns a contract for oil has to receive delivery on expiration if they're still holding the contract. And most of these people say, I'm not going to put it anywhere, like I'm not going to put it in my bathtub. So they're trying to desperate to get rid of that contract, and that's why you find that the price of these near-term contracts for oil are dropping like crazy, because 80–90% of the people who are engaged in that trade are not prepared to take delivery. So the implications for the real economy, for China, for Chinese consumers, for gasoline buyers like you and me are very little, because the real price that you should look at is the international price of oil, which is not subject to this weird technical feature, and that's the Brent price of crude, and that's in the 20s. Now, granted, that has come down, and that is a valid concern, because what does it mean? It means that the world economy has shut down, and the producers continue to produce.
Right. Mr. Lee, this has a lot to do with the pandemic that is going on right now, and social distancing, lockdowns, stopping or pause of the economy. So tell me more about whether this will have an impact, let's just say, about the future scale and ways the economies would work. That is the bigger fear, isn't it? The huge change as to how economies would function, whether it has much to do anymore with oil.
Absolutely. That's a great question to ask, because right now, certainly in the United States economy is transforming itself from just a pure consuming economy, oil-consuming economy, to one that's also producing oil. In fact, the United States is one of the largest oil producers in the world right now. And so for the U.S., the results are mixed. The lower price of oil is great for consumers, because I can buy gasoline at below $2 a gallon. But the producers are hurting, and the producers are particularly vulnerable. And the reason why we're concerned about oil producers is because many of them borrow in the financial markets, and they're heavily indebted. In fact, the debt that they borrow is called junk bonds, because they are so speculative. And the fear is that if these producers go out of business, then the collapse of that particular segment of the financial market may have consequences that roll out to the rest of the financial markets. I don't think that's a real risk, but it's a possibility, and that's what the authorities are watching for.
Right. And now we are also joined in our discussion from Hong Kong, Mr. Hong Hao, who is the Managing Director and also Head of Research at Bocom International. Mr. Hong, welcome to the program. Since we talk about the financial market, I would love to drag you into this conversation. Today, we've already seen some of those buyers of certain stocks or certain financial services related to crude oil prices have been, picking up their argument against the banks where they bought this service from, and were supposed to sue those banks because they thought they lost hugely as a result of the turbulence of the crude oil. So tell me more about that.
Well, I think it's related to the structure of the product. Now, basically, yesterday when the oil futures price plunged well below zero, there was no stop-loss mechanism according to the contract, which there was such a term in the contract calling for stop-loss of, I think, between 20 to 50%. So holders of this product, which is essentially the holders of the underlying oil contract, didn't get the stop-loss protection. So as a result, many of the buyers woke up to find that they not only lost all of their capital, but also owe the bank some money. So I think that's sort of inciting outrage in the investment community.
Right. And this is the very first time, Mr. Hong, if I remember right, 21 years since we have, the oil's future prices goes like this, negative. So have we seen any precedents in the financial markets earlier that we could learn from, or, at least to use as a reference?
Well, what happened yesterday was entirely irrational. So basically, everybody was trying to rush out of the door. And because the market liquidity for the May contract was very thin, so nobody got to get out. So if you look at the trading activities yesterday, basically there was each contract trades for about 5 seconds. So basically, the trading activity was very slow because there was not enough liquidity in the system for everybody to get out. So I think, as a result, the product that we mentioned just now couldn't get out, probably because of a tremendous lack of liquidity in the system. Now, I think previously, I don't think anyone has seen negative price before. You know, after all, you have to incur costs to dig the oil out of the ground, and also you have to pay for the storage as well. Right. So, you know, this is totally unprecedented, and I think the June contract earlier today was experiencing a tremendous sell down as well, because some of the oil ETF was trying to roll the contract to further out months.
Yeah. Mr. Lee, your comment.
Yeah, I was just going to say, I want to add to Mr. Hong's comment in terms of a policy perspective. The lack of liquidity that he mentioned is such a vital issue. The Federal Reserve has, for example, enacted policies where it became a market maker in various segments of the financial markets, including the corporate bond market. But the key about this market, the futures market for oil, is that it's a highly speculative market. And in that sense, it's not worthwhile for policy to try to protect speculators. Speculators, by definition, are there to make money and lose money in a very big way. And everyone who's engaged in that market is generally a professional and ready to take the gains and the losses. So from a social contract perspective, from a policy perspective, one of the things that we should allow is for this large price volatilities in the futures market to get rid of the bad speculation and also to allow price discovery, because it's very important for the futures market to be operational and operating well and in a liquid way, because the spot price of oil, which is what we are affected by, the long-term contract price of oil is determined in part by this futures market. So from a financial plumbing, regulatory policy perspective, it's important to keep the market healthy, but policy should not go into support prices in these markets.
That's a very delicate balance, isn't it, Mr. Hong, particularly when we are in a pandemic and everything seems to be very vulnerable. Policymakers and policy banks seem to come out even more frequently than they used to be in order just to save everything, quote unquote. But there is a degree that they shouldn't go, no matter how tempted it could be. Mr. Hong.
Yeah, I think so too. But I think central bankers are between the rock and the hard place, especially in the U.S. I think before the crisis, the U.S. system is highly leveraged, and also because of the savings, very low savings in the U.S. Society. So I think people need cash to get by. I still remember when there was a debate on the budget deficit, the budget deficit ceiling. The Capitol Hill was stopped for a few days, and then people had to go out to work at McDonald's and all that. So it shows that how tremendously the system is leveraged. So I would say that at this point in time, even though we're seeing unprecedented amount of liquidity is being pumped into the system, but I would say it's probably what is required right now. Because unless you want the system to collapse entirely, you just have to pump the liquidity into the system.
Well, Mr. Lee, that's the argument always from the financial services, isn't it? They would say, oh, if you don't want everybody to fail, then don't fail us first. Of course, Mr. Hong coming from the financial services, just to be fair here, Mr. Hong, I'm not saying this against you personally. I'm just saying this as a logic. So Mr. Lee, what do you make of that? I mean, the financial services are full of talents, smart people. They know how to argue with the policymakers. But, for the general health of the economy, Mr. Lee, and Mr. Hong, of course, later to respond as well, how should we look at this fund balance once again?
I think one of the things important, as Mr. Hong was mentioning, was to make sure that money gets to the people who need it and the businesses who need it. The people who need it are the people who are laid off by the virus. And they're laid off not because they're not working efficiently or because their job is not important. They're laid off because the government shut them down for health reasons. And I think this is true worldwide. So safety social nets are very, very important to ensure that people have adequate income during the shutdown phase, and support for small businesses and medium-sized businesses is incredibly vital so that when we open up again, business can resume without interruption. Now, one of the things that I must say, I used to work for Citibank as their chief U.S. economist, and I have to say that there's a lot of arguments for why the financial system, that the system itself has to be preserved. But no one in the argument would argue, not even the people at Citi, that we should come in and preserve particular markets or particular people who participate in the markets. If you're a systemically important institution like Citi was during the 2008 crisis, the Treasury came in to save the financial system, because if they went down, the rest of the economy would go down with it, and we would go back to the 1930s and witness that kind of terrible depression. That was why we stepped in 2008. Right now, the banking system is very healthy, and all the systemic components of the financial system are being held by the Fed, providing market-making facilities and liquidity.
Okay.
Right now, speculators in the oil market, they can take their hits.
Speculative trading, we're not going to support it. Mr. Lee says so. Mr. Hong?
Well, I will have to agree with Dr. Lee.
Sorry?
Yeah.
Did you,
well,
what did
I
you say
have to
again?
agree with Dr. Lee.
Yeah? Okay, go ahead.
I'll have to agree with Dr. Lee. Well, basically what happened is that, you know, if you don't pump the liquidity in the system, you know, for example, the commercial paper market is basically frozen, right? So, you know, corporates who wants to get access to credit, they won't be able to get it. The problem is that, you know, you don't want businesses to fail because of the shortage of cash flow. You know, these are perfectly viable businesses. You know, some have a very long operating history in the market, and suddenly, you know, just because of a short-term working capital problem, you know, you shut them out of the system. You know, that's probably not fair for them, and also it's really bad for the economy.
Wow.
So I would say that the Fed had done what it had to do, and I think, you know, all the experiences from 2008 and also from the 1930s Great Depression actually call for such endeavor from the Fed.
Well, it certainly calls for such endeavor to a certain degree, but it also calls for such endeavor to have a balance, particularly to invest into the real economy rather than just the financial services. There's already counter-argument from 2008 and 2009 about the financial crisis of too much money going into the financial sector to save those banks who should be actually saving themselves throughout the years. But, you know, I have personally no opposition against the banking services or anything, but let's continue another aspect of this discussion. The two gentlemen with me, Mr. Lee, about the oil industry and its relationship with the general economy. Now, that is very real, and that's certainly crucial as well. How will the impact of the futures market, shall I say, filter in to the real economy of oil and the real trading of oil?
In the United States, as I said earlier, the U.S. Oil industry has become much larger and much larger source of employment, especially the fracking industry. Now, one of the things about fracking is that it is, again, highly speculative in terms of exploration, and very often the wells that they drill are not successful. So in order to support this industry and to allow it to continue to be a competitor in the global industry against Saudi Arabia and some of the other oil producers, President Trump has said that we will try to protect the oil industry itself. That does not say that we want to have every company make money. In fact, the companies that are not doing it well should be closed and collapsed into the more successful companies. So for social policy and for political policy, one of the most important things to look at would be how you intervene into that oil industry to provide the kind of support that preserves employment and also allocates the funding into the more efficient companies. And that is allowing the financial markets to work in a way that is fully functional, but at the same time allowing companies to go bankrupt.
Okay. And Mr. Hong, of course, that's for the United States, what Mr. Lee just mentioned. But there are other parts of the world that are crucial, both producing and also consuming the oil. So, Mr. Hong, what do you make of the earlier interactions among oil producers from OPEC and some of the other economies that are producing oil, try to cut the oil production amount, and yet did not work apparently under the current circumstances. And this time, when the futures market of oil prices dropped to such a degree in the U.S., what does this mean to the real economy of oil?
Yeah, well, I think it's a tremendous hit on demand because of the virus. So even though the OPEC Plus organization is trying to cut, they're not cutting nearly enough. You know, so they're cutting about 10 million barrels a day, but I think the demand shrunk more than 20 million barrels a day. So basically, you're still in excess of a couple of 100 million barrels a day, and it's very difficult to store all those excess oil in the ground and also on oil tankers as well. So I would say that with the price being so negative and also the pressure on price continue to persist, before long you'll probably see some U.S. oil producers starting to shut down production. I think for now they're hesitant to do so, because shutting down oil production can be very expensive if later day you want to reopen them. Right. So I think they are now waiting out, to see whether the price will come back. I think for Chinese oil refiners, though, historically, lower oil price tend to be a good news and also, supportive for the expanding margin. Now the problem is that now because the end demand got hit, so even if you refine all those oil on a cheaper input cost, you still cannot find enough end demand, for your refinery products. So that's why, even though oil price came down dramatically, we're still seeing stock price pressure on those Chinese oil refiners.
Right. Of course, it has a lot to do also the future price of oil with the so-called storage space, 65–75%. Now it's going more than that. So, Mr. Li, what about that? The real industry, it's really about supply demand, right? It's really about consumption and also production. So how does these traditional logic of the market work in terms of the oil industry as a result of this?
That's a great question, because let's remember how the oil price started to collapse so rapidly. Yes, the lack of demand was a huge contributing factor, but Saudi Arabia declared war on Russia and some of the renegade members of OPEC. So they essentially started pumping like crazy and said, if you don't fall in line with your agreed upon cuts, I'm going to flood the markets and make you go out of business. So that initial war that the Saudis had with Russia was the spark that really created this huge turbulence in the oil prices. Then we tried to have an agreement, and the U.S. President Trump tried to broker a deal with these people and said, look, why don't we try to be reasonable about the amount of cutbacks? Even Texas producers, as a state, the organized producers are saying, if you all agree to stay with your quotas, the United States will also cut back on its production, even though, as Mr. Hong said, it's so expensive and some of it will drive some of our business out of business. It's so important for us to restore order because the world economy depends on stable oil prices. It could be at a declining a low level, but it has to get there slowly and not at this very rapid pace, induced mainly by the virus.
Yeah, so gentlemen, I think it's a legitimate question for me to ask here. So what's likely to be the logic of this story for the near future? I mean, 21 years, they say, never like this before, but we are experiencing it right now. And pandemic is very unpredictable. Everything about the economy probably will be eventually decided by this virus before vaccine. So what does it mean? Are we going to see this kinds of unprecedented occurring once and again? Are going to see turbulences unexpected at any time of the oil market, particularly the future of the oil market, and eventually filter into the real market, and into the pump stations that we are facing every day when driving to work? Mr. Hong.
Yeah, well, I think supply come back in line with demand. I think the volatility in oil price is going to continue, especially if you look at the June contracts, which is probably going to be settled within a month. Now the problem is that you don't see storage space getting more, so you're actually getting less and less storage space, and therefore more and more expensive. And also, I'm not seeing enough cuts, from the oil producers, and also the U.S. shale gas producers are not cutting fast enough. So as a result, it's quite likely that if nothing happened, then we're going to see a similar situation when the June contract comes settled.
Well, it's coming. It's coming, Mr. Li.
I would say that right now the key thing to watch for is that this is a turning point for Saudi Arabia. If Saudi Arabia does not gain control back onto the price of oil, we might actually see the collapse of OPEC, or at least the influence of Saudi Arabia in OPEC. Because if the renegade producers continue to produce at such high volumes, the disastrous scenario that Mr. Hong just mentioned may in fact come true. So Saudi Arabia has a great interest now and tremendous pressure on it as the leader of OPEC to be able to try to contain the amount of pumping that's going on among its members. So the thing to watch out for from a policy perspective is what's going to happen to Saudi Arabia, and will OPEC be able to hang together?
Well, this is a quite interesting chess that we're seeing right now. One lead to another, action and reaction, some predictable, some unpredictable, some with strategies, some not be ruled by strategy. So I want to thank both of you. This is this stage of the chess. We'll see what's going to happen next. The Hong Hao, William Lee, really appreciate it. Thank you so much for your insights. You're watching World Insights. Still to come on the program. The New Development Bank is supporting developing countries combat the coronavirus outbreak. We speak to the bank's vice president to find out more. Welcome back. You're watching World Insight. I'm Tian Wei. Well, Chinese frontline workers are busy turning the tide against COVID-19. China as a whole has been dealing with the pandemic's social and economic impact. Thankfully, there's helping hand for China, the country, and also for other emerging economies. The New Development Bank has issued a 5 billion yuan in coronavirus combating bonds to China with an eye on helping cope with the enormous cost of the pandemic. Earlier, I talked to NDB, New Development Bank's Vice President Leslie Masdorp. He explained in detail how the NDB is helping developing nations and emerging economies like China to overcome both health and financial difficulties. Leslie, good to see you. Let me start by asking you, how is the New Development Bank trying to help the emerging economies who are all struggling right now with the COVID-19?
New Development Bank has looked at the current crisis and decided to invoke a clause which allows us to do emergency assistance programs. And this loan is focused on helping China to deal with the unexpected expenditures in the healthcare system linked to the three most affected regions in China, that's Hebei, Henan, as well as Guangdong. So the bank provided this $1 billion loan to China to help with medical supplies, procurement of protective gear for frontline health workers, procuring more ventilators, and everything associated with dealing with the pandemic. So we recognize that whilst our core mandate is building infrastructure, bricks and mortar infrastructure, building dams and power stations and ports and rail lines, etc., right now our member countries are confronted with a historic public health emergency. So we are providing emergency assistance loans to our member countries. We started with China, and we are about to engage in similar discussions with South Africa, as well as with India and Brazil.
Okay, I see. It seems to be a great idea. However, Leslie, as you may know, we also understand that AIIB has also started a similar project providing healthcare infrastructure funding for China, particularly in the municipalities of Beijing and Chongqing. Tell me more about that.
As you can imagine, the scale of the financial and fiscal support required is enormous. By definition, therefore, multilateral development banks will work in a coordinated fashion, okay, to do complementary efforts so that we don't all do the same thing. So our support is to these provincial governments. The provinces may decide, based on the needs, to devote some of those expenditure to particular municipalities that are most affected. But multilateral banks, as you know, Tian Wei, we are all working in the same space. We work for the public good. We are development finance institutions. So we are in daily, in regular contact with Asia Infrastructure Investment Bank. I will be speaking to the CFO in a matter of hours. So we work in a complementary fashion. There's no sort of competitive dynamic between these.
Different emerging economies are going through this COVID-19 at different stages. So what is the best way to make sure resources can be used the most efficient way?
I think, as you correctly pointed out earlier on, the first priority is the public health emergency. We've got to contain the spread of this pandemic. We have to make sure that developing countries have access to the kinds of medical supplies, ventilators, respirators, everything required to deal with COVID-19. However, when it comes to targeted economic interventions to deal with the economic crisis that is likely facing us now, because the world economy, everybody assumes now, baseline assumption, is going to go into recession. So now I think the principal focus has to be on preserving jobs. Keeping people in employment is the #1 priority. So all of the economic interventions that are being thought of right now has to be focused on alleviating the burdens on businesses, especially small and medium-sized businesses. You know, the mom-and-pop store out there, the people who employ 10, 20, 50, and 100 people. Those are the businesses that sustain a modern economy, providing services. So protecting people's jobs is the safest and surest way for us to be resilient and to emerge out of this crisis.
Mr. Masdorp, we are facing a reality that is more complicated than we could ever imagine. You talk about the pandemic, unprecedented in our lifetime at least, and then also the economic recession, possibly also in a scale that we have never seen before. Plus the already existing complicated geopolitics. It makes everything more than complicated. So, Mr. Masdorp, what does it mean for multilateral financial institutions like yours, the New Development Bank, at this point?
Multilateral banks have been set up with public good objectives. Our mandate is around development. We look at sustainable development as our core objective. So we have the advantage that we look at the world through very long-term lenses. We're not like a commercial bank like ICBC or Goldman Sachs or Standard Chartered who have to deliver profits to the shareholders every quarter and every financial year so that they can distribute dividends so shareholders can see a return on their money. We have the advantage that we were set up with long-term objectives. So it's exactly at the moment like this where multilateral banks, the World Bank, the Asia Development Bank, the European Investment Bank, New Development Bank, all of us have been set up specifically to deal with crises of this nature, because we can take longer-term perspectives on the world. And then secondly, and very importantly, we have very high, some of the highest credit ratings in the world, which means that we are the most credit-worthy. We are some of the safest institutions. We can raise money in moments of crisis. The New Development Bank issued a bond in China. Although all of us are scattered around the world right now, we were able to raise 5 billion renminbi in the Chinese domestic capital market at very favorable pricing. Everything was done virtually. We were able to get all of our approvals from the regulators. So the bank has an enhanced mandate in moments of crisis, like in 2008, when the world went through a deep financial and global economic crisis. Multilateral banks significantly increased their lending. So our thinking caps are on. People are working 24/7 to come up with, looking for new ideas of how best we can be effective in this moment of crisis.
Vice President of the New Development Bank. During the interview, Mr. Masdorp weighed in on some of the speculations and conspiracies which propped up during the outbreak. He believes the priority at the moment is certainly to confront these rumors head-on and broaden education on the pandemic and its economic impact. On the one hand, the world has to make sure no rumors, no wrong understanding, particularly about science, has been circling around. On the other hand, the world has to concentrate on the real work of development and guard against pandemic and also the recession. This is a very complicated job. I want to invite your thoughts and wisdom on this.
You're spot on, Tian Wei. Right now, I think the first order priority is to confront head-on the fake news and disinformation out there. Secondly, is to broaden an education campaign around the most appropriate ways to deal with this health as well as the oncoming economic crisis. As you know, there are many people now using the spread of disinformation to sort of suggest that because the epidemic started in China, that China is now somehow benefiting from the economic chaos that is unfolding in the rest of the world. I think it is very important to confront those head-on. But more importantly, now is the time to base our decisions on science, on scientific data, information, and exchange. We can only deal with this health crisis by listening to the doctors and epidemiologists and those who understand viruses and who studied it all their lives, right? We cannot listen to people who have views about things that they are not educated in. In a similar way, in dealing with the economic crisis now, it must be based on scientific evidence, it must be based on data, it must be based on historical experience, how to confront this. But as I say, China has a critical role to play because it has emerged reasonably unscathed economically at this stage from the pandemic.
Mr. Mastorp, let me ask you also about these emerging economies, which you are very familiar with, you deal with every day. You know, China now somewhat coming out of the fire, but still have to be very cautious because nobody knows whether there will be resurgence. Just by science, we do not know much. Then India, a huge population, 1.3 billion, and we see in some part of the slum, for example, there are already some severe situations of signs of pandemic. Then South Africa, where you are based right now, we also see cases are increasing. The African continent is also a place of attention. So, Mr. Mastorp, it seems that there are crises everywhere. How to coordinate?
We are reliant right now, Tian, on policymakers, people in leadership positions in each of these emerging markets to take stock of the situation that confront them in a realistic manner. Fortunately for Africa, and this is a very important sort of starting point, the pandemic came quite late after having reached a climax in China, having peaked in places like Italy, in Spain, the rest of Europe, United Kingdom, United States. So Africa, fortunately, the pandemic has only really sort of hit the continent in the early parts of March. So people have seen the extent of the public health crisis and how hospitals were overrun in many parts of the world. So immediately, countries have adopted social distancing policies, lockdowns at great expense to the economy. So the governments in Africa, including here in South Africa, we are currently under lockdown, a 21-day lockdown, where everything has been shut down. So people are unable to make a living by going to work and selling their goods or going to the factories to produce. But we all recognize that this is what is required of us right now. So there's a collective pain, collective suffering all together. With respect to the coordination, I think the first, once out of the health crisis, we can then begin to, in a more coordinated fashion, markets, using the global platforms like the G20 and others, to develop strategies in a coordinated manner. We also have one of the biggest crises in the energy markets. Oil prices have never been this low. So in Africa, we have countries like Angola, like Gabon, like Nigeria. 85% of their revenues come from oil.
So it seems that we have to deal with all of these crises one by one and all at the same time. It certainly needs a lot of skills and capacity. Mr. Mastorp, before we go, I want to ask you a final question. What do you think this crisis has taught us so far?
One of the aspects that the crisis brings, that the crisis shines a brighter light on, are the internal contradictions in each society. For example, what the crisis has done, it is brought into sharper focus the inequalities that we have. I mean, as you know, some people live in wealthy suburbs, others live in densely populated, overcrowded townships and slums, right? Seeing those images on television now of villages without access to basic water and sanitation and so on, looking at how the struggles of rural people in the rural areas disconnected from mainline services. When we emerge post this crisis, we can never return back to normal, Tian Wei. We cannot make these forms of inequality permanent features of our society. Now is the time to deal with those contradictions in society, and when we emerge after the crisis, we need to solve those problems, improve the quality of clinics and hospitals in the rural areas, have better housing for people in these densely populated urban areas, and deal with the levels of inequality.
And that is all the time we have for this edition of World Insight. To find out more, search for us, World Insight, CGTN, or check out our YouTube channel, follow us on Twitter and Facebook accounts. From me, Tian Wei, and everyone on the World Insight team, thanks for watching. Bye for now.